Good morning, trader. AUD USD looks like it wants to break out, but Australia just dropped a trade balance number that makes going long here feel like walking into a glass door you didn't see. The daily chart says uptrend. The 4-hour chart says uptrend. Welcome back to Aplua Market Meridian. I am Eric. The data underneath says hold on, check your assumptions. Right now the Aussie is sitting at 0.7246, less than a single pip from the 0.7248 resistance that has capped price all session, and honestly, that is where the trap is set. There is one danger zone and one hidden opportunity today. I am going to show you both. If you stay until the end, I am giving out 3 exact entry and exit levels you can use right now for your next session. Write this number down. 0.7186. That is the invalidation level today. If we close below 0.7186 on the 4-hour chart, the entire bullish structure that has been building for a week gets called into question. Above it, the session bias is fading. That means we are in a trending environment where shallow pullbacks toward moving average support are being bought, not sold. But we are fading that trend right at the resistance gate, meaning we expect one more test and potential failure before a deeper correction or a clean breakout. If 0.7248 breaks with a 10-minute candle close above it, the fade bias is wrong and we shift to full breakout mode. Until then, we fade with precision. Most traders will see the daily candle and chase the breakout. We are not most traders. We are going to let the level prove itself first. Let's walk the chart from top to bottom. On the weekly time frame, Australian dollar to US dollar is still pressing against a declining trendline that has been in place since the highs of early last year. The weekly moving averages are in a transition state. The 20-week average is flattening near 0.7120, the 60-week average is still sloping lower around 0.7380, and the 200-week average is way down near 0.6780. This tells you the longer-term structure is not yet a confirmed bull market. It is a recovery rally inside a larger range. Price is above the 20-week, which gives the shorter-term trend the benefit of the doubt, but it has not yet conquered the 60-week, which is the true trend-defining line for institutional positioning. When you zoom into the daily chart, the picture sharpens. The 20-day moving average is at 0.7201 and rising. The 60-day moving average is at 0.7155 and also rising. The 200-day moving average is the brick wall sitting at 0.7280, and it is flat, not yet sloping up. That flat 200-day is acting like a magnetic ceiling. Price has tested it twice in recent weeks and both times got rejected. A third test is setting up right now, and the old market adage holds: the more times you bang on a door, the more likely it breaks. But if the fundamentals just shifted under your feet, that door can turn into a trapdoor. On the daily MACD, we have a histogram that is still printing green bars, but the signal line is flattening and the slope of the histogram is compressing. That is early-stage momentum loss. It is not bearish yet, but buyers are losing their grip. The next few daily candles will determine whether we get a bullish MACD reacceleration or a bearish crossover that catches late longs off guard. Now drop into the 4-hour chart, which is where our trade setups will be born. The 20-period moving average on the 4-hour is at 0.7240, almost exactly current price, so we are trading right on the edge of short-term momentum. The 60-period moving average is at 0.7218 and rising, which gives you a dynamic support band between 0.7218 and the horizontal pivot at 0.7186. The 200-period moving average on the 4-hour is way down at 0.7045, but it is rising steeply, and that tells you the medium-term trend is genuinely bullish, not just a dead cat bounce. The problem is the 4-hour MACD. We have a negative divergence that started forming about 24 hours ago. Price made a higher high near 0.7258 during the last swing, and the MACD histogram made a lower high. That is classic exhaustion. When you see that divergence against a horizontal resistance zone, you do not blindly buy the breakout. You wait for confirmation or you fade it with a tight stop. That divergence is the reason why today's bias is fading and not trending. It is also why the trade balance miss matters more than usual. A data point that would normally be shrugged off now becomes the catalyst that triggers the divergence. Resolution. Price wants to correct, and the news might give it the excuse that on the hourly chart, the moving averages are bunching up. The 20-hour is at 0.7242, the 60-hour at 0.7238, and the 200-hour at 0.7225. When you see this compression on the hourly, it is the calm before the expansion. The hourly MACD has already crossed bearish, but the histogram bars are tiny, which means there is no conviction yet. This compression typically resolves within 1 or 2 sessions. The key support levels on the day are 0.7225 as the first intraday line, then the 0.7186 to 0.7164 zone as the stronger structural floor. The key resistance levels are 0.7248 as the immediate gate, and 0.7288 as the breakout target where the 200-day moving average sits. Everything between 0.7248 and 0.7288 is noise, a breakout zone where stops cluster and algorithms run. Above 0.7288, the market structure flips fully bullish on the daily, and the target extends to 0.7380, which is the 60-week moving average I mentioned earlier. Below 0.7164, the 4-hour and daily charts lose their bullish structure, and 0.7045, the 4-hour 200-period moving average, becomes the magnet. These levels are not arbitrary. They are the lines where institutions have options barriers and stop clusters sitting. Now we must talk about the cross-asset linkage, because the Australian dollar is the China proxy and the risk barometer, and right now it is sending a message that the equity market has not fully acknowledged yet. I track the Nike 225 and the S&P 500 futures against the Aussie because when risk appetite is genuine, all three move in the same direction. The Nike is grinding higher, confirming the risk on bid, but the S&P is stalling at its own gamma wall. Gold is explosive to the upside, which is normally a risk-off signal, but the move in gold right now is partly geopolitical fear and partly a real yield repricing that has not yet spilled over into a stronger dollar. Here is the critical cross-check. Oil, the geopolitical heartbeat, is bid above key support, which should be tailwind for the Aussie because Australia is a commodity export economy. But the Australian trade balance just shrank unexpectedly because exports lagged while imports held firm. That means the commodity price tailwind is not translating into trade surplus expansion the way the market expected. Iron ore demand out of China is stable but not accelerating, and Chinese equity markets are still struggling to hold their breakout levels. When the China proxy cannot rally even with oil and gold bid, you have to question whether the risk-on move is real or rotational. If we see the S&P 500 break lower and the Nike reverse, the Aussie will be the first currency pair to crack. That is what makes 0.7186 so important. It is the line where the risk-on narrative gets seriously challenged. Here is what most traders miss. The Australian dollar is not just about the Reserve Bank of Australia or the trade balance. It is a funding currency. 4 carry trades and a positioning vehicle for global macro funds expressing a view on Chinese stimulus. When the market expects Chinese fiscal expansion, the Aussie gets bought ahead of the announcement. When those expectations fade, the longs get unwound aggressively. The RBA minutes and recent rhetoric have been cautiously hawkish, but the market is pricing only a shallow rate cut cycle that is months away. The yield differential between Australian bonds and US Treasuries has narrowed slightly in the Aussie's favour, but not enough to drive a sustained breakout above 0.73. For the 1 to 2 week directional lean, I am cautiously bullish above 0.7186, but I need to see a clean daily close above 0.7288 to add conviction. If 0.7164 breaks, the lean flips to neutral bearish, and I expect a fast move towards 0.7045. The event that would invalidate the bullish thesis entirely is a downside surprise in Chinese PMI data next week, or a hawkish repricing of the Federal Reserve after the next US inflation print. Write that down. Chinese PMI and US core CPI are the two catalysts that will make or break this pair. Now we move into the trade setups. Most people will click away right now, but this is where money is made. Keep watching. Kindly subscribe my channel before coming to Strategy 1, the sniper, conservative. This setup is for a pullback into confirmed support with a momentum confirmation. The trigger condition is a 4-hour candle close inside the 0.7195 to 0.7186 zone, followed by a bullish hourly MACD crossover or a bullish pin bar on the hourly chart within the next 12 hours. Entry is on the break of that pin bar high, or manually at 0.7195 if the MACD crossover fires first. Stop loss goes at 0.7160, just below the 0.7164 structural support, giving the trade room to breathe. The risk on this entry relative to a 35 pip stop is tight and clean. Target 1 is 0.7240, which is the 20-period 4-hour moving average that will act as the first resistance on a bounce. Risk-reward to target 1 is roughly 1 to 1.3. Target 2 is 0.7275, just beneath the 200-day moving average and the 0.7288 resistance cluster. Risk-reward to target 2 is 1 to 2.3. The setup is voided if price closes below 0.7160 on a 4-hour candle. No excuses. Strategy 2, the active trader, standard. This setup is a mean reversion entry on the hourly 200-period moving average. Entry trigger is a touch of the 0.7225 level with a stochastics oversold cross on the hourly chart, or a bullish engulfing candle on the 15-minute time frame. I want to see price approach 0.7225, stall, and then show a reversal candle before I enter. Stop loss goes at 0.7204, below the 60-period moving average on the 4-hour and below yesterday's intraday value area low. Target 1 is 0.7248, the gate. Risk-reward to target 1 is roughly 1 to 1 exactly, so this is where the trailing stop rule kicks in. Once target 1 is hit, move the stop loss to break even and let the rest run toward target 2 at 0.7280. The trailing stop then shifts to the 20-period moving average on the hourly chart to capture any further extension. If the trailing stop is hit, you bank your profit and wait for the next setup. Now let us see how aligned we really are. Type your Australian dollar to US dollar range for tomorrow in the comments right now. I want to see where you think the high and the low will print. I read them every day, and the best ranges get a shout out in the next video. Strategy 3, the Aggressor, high risk. This setup is a counter-trend fade at the 0.7248 resistance, directly fading the 4-hour negative divergence I described. Entry trigger is a 15-minute bearish engulfing candle or a shooting star rejection at 0.7248, with the hourly RSI above 62 and turning down. I want to see volume spike on the rejection candle. Entry is on the break of that rejection candle low. Stop loss goes at 0.7262, tight, above the recent swing high and above the 0.7258 local top. Target 1 is 0.7225, the hourly 200-period moving average. Risk-reward to target 1 is about 1 to 1.2. Target 2 is 0.7190, just above the structural support zone. Risk-reward to target 2 expands to 1 to 2.4. This setup is voided immediately if a 15-minute candle closes above 0.7258. Only for those who know how to lose small and manage risk aggressively. If you are new to trading or cannot accept a rapid stop-out, do not take this trade. Never risk more than 1 to 2% per trade. No positions through high-impact news like Australian employment data or US CPI. Stops are non-negotiable. If you cannot place a stop-loss, you cannot place the trade. The one critical level for the next session is 0.7248. A 4-hour close above it opens the door to 0.7288 and potentially 0.7380. A rejection keeps us range-bound between 0.7248 and 0.7186, and a break below 0.7164 ends the bullish structure. Tomorrow we focus on whether the Australian employment data or any Chinese stimulus headlines can force that resolution. If you want the full breakdown on Bitcoin and the S&P 500 divergence, that video is live now. Check the end screen, and I will walk you through why risk assets are not all moving together and where the fracture point is. Smash like if this analysis gave you a clear plan. Subscribe and hit the bell for daily coverage of 8 key assets across Forex, commodities, and crypto. I will see you in the next one.